Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to learn something about AMC and GME Options Basics 101. So let us begin. Here is an option chain for AMC. AMC closed at 8.01 on Friday, that is February 26, 2021, traded 137 million shares. Anyway, at $8, we just look at here, we're going to look at the strike price, then we're going to look at the open interest, we're going to look at gamma, we're going to look at delta, we're going to look at theta, which is the time decay. We're going to look at implied volatility, intrinsic value, and time value, and try to make some sense and compare this with the similar parameters with the GME stock and see what we can learn from this. When the stock price and the option price are pretty much equal, the intrinsic value of that stock is going to be practically zero. Whatever the premium they are charging will be entirely time value. For example, this is March 5th, 2021 expiring option for AMC, an $8 option. As of Friday, when the market closed, it was worth $1. Remember now, there are only 5 days in the first week of March. For 5 days, you're giving $1 premium. That is 12% of the stock value. So it is a pretty high premium for an option for 5 days. That's one important point I want to make. Number two, look at the number of options that are outstanding, 15,250. These people are thinking that, the stock is going to go up, and that's why there's a tremendous interest in the call options. We can pull up put options if you like and see what it shows. Okay, as you can see, the put option is only like 6,713 compared to the call options. So let's go back to the call options. So we looked at the premium, which is extremely high, 12% for 5 days. It's like paying 12% interest for 5 days. And the high call interest. And the next thing is delta. Delta, I'm going to explain in a minute. The delta is 0.56. It simply means that for every dollar increase in the stock price, the option price will go up by $0.56. So let's keep these numbers in mind and let's do some basic physics. Let's start off with some option basics. The option prices are based on the underlying security, time to expiration, which relates to time decay, which costs money each minute and each hour you're holding the option. There's the delta, which I just mentioned to you about. It is based upon interest rates, and most importantly, for AMC and GME stocks, it is the implied volatility. The volatility is between 20 to 30%, and we will see what it is when it comes to. So let us continue with an important aspect. This is the one that talks about delta. Delta is the rate of change in the option price for every dollar increase in the stock price. And if you have a XYZ 60 call, and if the stock price is $60, any increase in stock price will give you like 0.6 delta. And as you go deeper and deeper into money, then it reaches like 95, 97%. For every dollar, you're getting 97, 98 cents. On the other hand, when it goes down, it follows the same pattern. Stock goes down from 60 to 55, you lose almost like 40% or 30% of the value, and then it just goes pretty quickly. The rate at which it changes is known as the gamma. Let's see if I can show that one. Okay, now let's talk about the time decay. Time decay is of great value And let me go back to the stock here for a second. And here we are looking at call option 8 for AMC, and it is $1, and the time value is 0.9777, so $0.98. So that's for 5 days. So the stock practically has like 20 cents per day time decay value, because first day 20 cents, second day 20 cents, and by the fifth day $1, it's gone. Assuming the stock doesn't move anywhere, or it will come back to the same point by next Friday. That is the time value. But the time decay is so intriguing that this chart explains a whole lot about time decay. Most of the time, if you buy an option, say like 3 months or 4 months in advance, say for example you had bought an AMC option in December. From December, January, February, 3 months, it would have lost only 30% of its time value over 3 months. But however, if you had bought this 30 days before the expiration, 70% of that value would have decreased over 30 days. So the time decay is exponentially severe if you are buying a stock that is less than 4 weeks. That's an important lesson. So if you think the stock market is going to move in your direction, and if you feel that you are going to make some money, make sure you have some room so that if the stock goes against you and it has time to come back, then you will have an opportunity to recover part or most of your investment, because if you had a short-term option, it would expire worthless, then it's not good. The time decay is something that you need to keep in mind, and as I told you here, the time decay, most of the premium is related to time, as there is no intrinsic value built into this. Every minute it is costing you for holding this option. Let's move to the next item here, and that is the gamma. Gamma is basically if the stock is at $50 and the delta of that underlying security is 0.5. If it goes up $1, the option price would go up by 60 cents. In other words, the gamma is the change from the baseline to the next stop is 10 cents. And for the next second dollar, it will be like 8 cents. And this is based on 60 days. But look at what happens here. If your delta, you have 1 day from expiration. If your price is 50 cent, delta is 50, and if the stock price goes from 50 to 51, then the increase will be like 0.4. It will be dramatically different because you don't have much time, and any value above the strike has to go into the option price. Because here you have time, so it doesn't go up so quickly. So that's an important thing to keep in mind. Let's come back here. Let's look at another important thing. Theta we talked about, and implied volatility. Implied volatility just tells us how volatile a given stock or an option or any other business transaction in the stock market. If there is high fluctuations in the stock or the underlying security, if there are high speculations of good news or bad news, the implied volatility goes up tremendously. Just to give you an example, let me pull up QQQ, which is a NASDAQ option. The implied volatility of NASDAQ QQQ is 32 to 31 to 36% during the same period. For the options, and I just want to bring your attention here, the option, the ETF price was $3.15, and if you look at the $3.14, the premium was $6, which is like 2% of the stock price. Whereas with the AMC, whereas with AMC, it is 12% of the stock price. Because of increased volatility, because of increased speculations, you pay a much higher premium for an underlying security because of the uncertainties. Now let's go to GME and see how things are there. Then we're going to put a chart together for both and see what we need to do. Okay, GMC closed at 101.74. Let's take 102 for example. And look at this, $25.35. The intrinsic value is practically zero here. Okay, as you can see, the intrinsic value is zero. But just that $25.35 is the time premium for 5 days. 1, 2, 3, 4, 5 days. That is $5 per day. But in total, for 5 days, you're paying a 25% of the stock value in premium for the privilege of hoping that the stock would go up and you make some money. But remember, you're paying a tremendous price in terms of premium. And why is this premium so high? If you look at the implied volatility, it is 493 to 500. It's extremely high volatility. When you realize last Friday, when the stock went from 47 to 97 or over 100, it was almost a 100% jump. So in order to accommodate these kinds of wild fluctuations, the implied volatility goes exceedingly high off the scale, and that's why you're paying these high premiums because of the implied volatility. This happens very frequently, like when Apple or Amazon is ready to announce. They expect a stock to move 5% or 10%, and all the 5 or 10% is included in the premium of the calls and puts in both directions, because they figure that if the stock were to jump 10%, that increase in premium would already be figured into the option just before the market closes. I have seen this happen so many times. So that's an important thing that we should learn from here. The time value, intrinsic value is zero here, and the implied volatility. Implied volatility is something that will tell us there's something exceedingly unstable situation in these stocks. And the time decay, look at the time decay. Time decay, theta is the time decay. It is decaying at a much faster rate compared to AMC. Let me see here, AMC. Of course, it's 1/10 of what it was. It is like a 0.07, whereas it was 1.9. So it's considerably higher. Let me get back to my PowerPoint here and see what else I have. Here is one which kind of explains that gamma we were talking about. When the stock price changes, the delta changes, but with time, there is some element of changes related to. Whereas if the expiration is closest, then the delta would be much steeper compared to a long term where it has time to come, so the delta changes will be slower. Okay, keeping that in mind, now I put the AMC and GME options side by side to give you an idea as what is happening here. This is February 26, 21. AMC closed at 8.01, GME was 101, and the option prices for March, we picked like zero intrinsic value, 8 and 102. The premium was 12% here, 25% here. The delta were pretty close, 0.566, all right. Then theta, this is what I was talking about. The time decay is much less compared to the GME. But look at the implied volatility, 229 versus 495. And the intrinsic value is zero. And the time value, most of this money is for time value. It's $1 here and $25 and change here. And look at the open interest, because AMC has this gamma squeeze coming up Monday, that is tomorrow. There's 15,156 open interest compared to GME for the same period. March 5th has a 67 open interest in the options. So that is in a nutshell an introduction to options basics in terms of their strike price, open interest, delta, theta, which is important, implied volatility, intrinsic value, and time value. I hope this has been useful to you, and please do subscribe to our channel, and we will see you next time.